Hey.
Okay, perfect. So thank you very much. We are going to start the webinar today. It's been an exciting day, especially Sam today. He already did another webinar. So you should be very prepared for all the questionings going forward. So first of all, thank you everyone for joining our webinar today. Our topic will be on crypto derivatives in 2020. For the past couple of years and a couple of months, actually, it's been a very, very exciting times in the derivative space. So there are a lot of questions. I've known a lot of people who holds quite a lot of Bitcoin or different crypto, but are not particularly familiar in the derivative space. So this time we wanted to bring on all the big players like yourselves, our speakers today, and have them share more idea with us regarding on the crypto side. So before we start, I want to have a quick thanks to Block Effect, the marketing company on the blockchain side helping out today, as well as the platform provider, Remo. They've been very helpful the entire time setting up this UI UX experience for everyone to go forward. So today we'll start by introducing our speakers, and then we'll kick off with all the questions. A quick introduction on the platform first. For anyone who wants to enter your question on the right side of your screen, you can put down your question. I'll be watching it in real time. So if it's an interesting question, I'll bring it on and then ask our speakers. The entire thing will go on for roughly 45 to 50 minutes. So each question will be quite interesting to have our speakers go for it. So I'll start by introducing our speakers. I'll start with Mark. Mark is with CoinFLEX, the CEO of CoinFLEX. They are based out in Hong Kong. And then Sam would be on FTX side, also CEO of FTX. And Luuk will be from Deribit side, CCO of Deribit. So hi, everyone.
Hey, guys.
Hi.
Cool. I'll start off by having you guys with the first question actually hitting you guys. So as the topic today will be on crypto derivatives, the first question will be, what will be your main focus going into 2020? Or are there any exciting news that you'd like to share with us? Please maybe have Sam start first.
Yeah, so I think that for 2020, we're going to be focusing on rolling out a lot of new types of derivatives. So we rolled out options earlier this weekend, which we're pretty excited about, seeing a couple thousand Bitcoins a day trading there, which is, I guess not as much as the guy to my right, but we're still pretty happy with it. I think it's probably second highest in the space. We rolled out Pax Gold futures as well recently, which I think is kind of cool. And then I think going forward, we're expecting to roll out a whole suite of tokenized derivatives products. And, I think more details about that will be forthcoming over the next month. But we're pretty excited about that and sort of the platform that they'll be on.
Okay, thank you, Sam. What about yourself, Luuk? What are the new updates from Deribit that you would like to?
Yeah, so for us, we're focusing this month on the move of our hardware from OVH in Strasbourg to London, which might seem irrelevant, but for us it's actually quite important because unlike most of the other crypto derivatives platforms, we actually own our own hardware, meaning that we have our servers, etc., like a proper rack, and now we're upgrading all of that stuff to the latest state-of-the-art equipment. But also client racks, for example, we host servers of our clients. We can offer other co-location solutions. We can offer cross connects. We can offer virtual connectivity, and besides that, the typical standard internet connectivity, which will boost our processing capacity significantly. So we're quite proud of our latencies and the way we process transactions. But this new setup allows us to give this a significant boost, which allows us to do more, to attract more market makers, and also improve market quality. So especially in the options segment, if you have a lit order book where there's hundreds of different strikes and series, etc., you need a lot of updates per second. So if you have a lot of market makers, you need a lot of bandwidth in order to enable them to quote continuously, which is therefore really important to us. So that's going to happen the 25th of January. The test environment is already operational from London, but as of the end of this month, we'll run in production from there as well. After that, we're gonna do stuff like implementing KYC. We're gonna launch a POP in Asia. So some of the Asian clients tend to have connectivity issues with regards to the internet. So simply connecting from China, Hong Kong, etc., to London is simply distance. So what we're doing is opening a POP in Hong Kong, which has a dedicated line from Hong Kong to London, and one of the fastest round trips available, allowing them to trade faster. And besides that, naturally, we're looking at products after the launch. So we're looking at linear futures, we're looking at spots, so BTC versus ETH, stuff like that. Corporate-wise, we're moving our headquarters from the Netherlands to Panama with regards to European legislation. So that allows us to do more as well, which is restricted in Europe at the moment. So we will be able to compete better versus the other guys in these screens.
Thanks, Luke. All right, Mark, what do you have to tell us about what's going to happen with CoinFLEX coming for 2020?
Yeah, absolutely. So CoinFLEX in December of last year launched a bracket trading competition dynamic, and that basically was it kind of uses the TT ladder, which is one of our shareholders' trading technologies, and it uses some of the order types in TT. So with one click, you can place a trade that automatically has a stop loss and a take profit attached to it. And the nice thing about both the interface that we have on CoinFLEX and these competitions is you could trade really high volumes manually. So we had individual traders trading $10 million with just less than $1,000 in the account last time we had these competitions. We're going to be restarting these competitions and also creating a framework for users to create their own trading competitions. So if you want to run your own trading competition with the public, available to your friends or your affiliate followers, you can create a very, very configurable competition with configurable payouts and buy-ins and all these types of things. So we're very excited about basically gamifying futures trading. It's worked well so far. We want to double down on it and bring the community into creating their own competitions. We're also working on rolling out a lending product that we're really excited about because we're the only physically delivered futures exchange, and one of the benefits of physical delivery is you can actually do the basis trade without being an algo trader, so you can buy spot, sell futures, hold to expiry, and you don't have to worry about anything happening in the interim or any extra steps you need to take to cash in those profits at expiry.
Fantastic. Thank you very much, Mark. I want to touch back on some of the topics that Sam has actually brought in just now. It's more on a question on the new derivative products moving forward. So I want to ask, as the market is getting more mature right now, for you guys, I know everyone's moving slightly towards different directions. What new derivative products do you think is worth exploring or introducing to our crypto market? Maybe I'll have Sam start off again.
Yeah. So in general, I think that you can look to what exists in traditional finance right now and doesn't in crypto as some sort of roadmap. And so I think that one thing that you see a lot of is sort of various wrappers around various trades or strategies or things like that. And I think crypto is obviously a really obvious use case for that because of tokenization. And so I think that one thing that I would expect to see a lot more of is finding something that a lot of people want and tokenizing it. Whether it's a leveraged position, which we've done, whether it's a fund, or whether it's something else. So that's certainly one thing that I expect to see. I would definitely expect to see sort of integration of a lot of different products, between futures, options, newer and upcoming products, spot trading, margin trading, sort of all under one house and one margin regime. And I think that sort of I would expect to see a slow death of isolated margin in favor of cross and eventually portfolio margin, across sort of a wide spread of derivatives products. And I think that to some extent there are going to be things that will take off that we won't predict, and that we'll just sort of see someone try. It'll get a ton of quick adoption, and then a lot of other people jump on board.
Fantastic. Thank you, Sam. What about yourself, Luke?
Yeah, so as mentioned before, we're thinking of new, let's say, altcoin futures, linear futures, where unlike some of the other platforms, we like to use BTC as collateral. So we want to use a single asset class as collateral for multiple pairs. That's something we're considering. Some spot markets as well, but also what we tend to introduce is not only products but also the functionality. So we're focusing on the options part for the moment. So for options market makers, for example, we're launching mass quotes, allowing them to send 100 or 200 orders in one batch, which allows them to update their quotes faster without being picked off by other traders. Other stuff is market maker protection, for example, pooling quotes automatically in certain scenarios. So let's say you define a 5-second period where you don't want to trade more than 100 options, because if you do, there might be something wrong. So if you get hit or lifted in the books more than X times in a certain time frame, you automatically pool your quotes. But the same can be applied to deltas, for example, or Vegas. If you trade more than X deltas within 5 seconds, we pool your quotes. All of that allows market makers to quote better, reduce spreads, and make our market more competitive and more mature, and also more in line with the more traditional markets, allowing the traditional buy side, the size, to come in and allowing us to compete with firms like CME and Backed, also attracting a similar client base. So that's what we're looking at now. For retail clients, we've just launched a solution called Portfolio Builder, which is quite unique, where you can play around with theoretical positions and see how an option position straddles, triangles, etc., with futures, like a combination, how it behaves over time in certain scenarios. So what if Bitcoin goes to a certain level? What is the value of your portfolio? How can you best hedge against certain scenarios? And one of the features not yet used a lot is what we call hashing, where you can create a web link for your specific portfolio, and you can actually share that. So we hope to use it for more education, because that's, I think, what all of us are lacking. If you look at the derivative space, we need to work together and educate, especially the retail side, to further grow the market, because perpetual swaps or futures might be the most simple product, but there's way more advanced products out there that simply need guidance in order to avoid people from making mistakes.
Thank you, Luuk. Can everyone hear me?
Yep.
Perfect. Moving on to Mark. Keen to hear your thoughts as well. What are the new products you think will be suitable for our market?
Yeah, I think ultimately, right now, crypto is basically a retail-driven and basically speculative-driven market. So I think that actually lends itself really well to very, very short-term derivatives and also very configurable derivatives. So I think, users basically want to configure their own payout structures, configure their own trades in ways that have very specific payouts. And I think that will be a big part of where we go in 2020. And then also, from the professional side, a large part of the traditional market is spread trading, and maybe that's spread trading between spot and futures, or spread trading between one futures pair and another futures pair, or one derivative and another derivative. And I think that's going to be a big part of where the market goes in 2020, is basically the evolution of people that are making bets on where basis is and where the spreads are between different derivatives.
Interesting. Thank you very much. To make it smoother, I think for the questions moving forward, we just go with the same pattern, having Sam start first, and then Luuk, and then Mark, just so there's less confusion. So let's pick up one of the questions that we are seeing on the right-hand side. Are you seeing traders using mempool data to trade BTC volatility derivatives? We'll probably start with Sam. What are your thoughts on it?
This is a question about using mempool.
Yes.
Yeah. I'm going to be honest. I haven't seen it, but it could be happening. I don't know that I would know if it were happening. I haven't seen evidence of people doing it. I haven't seen people talking about it very much. And sort of when I do, except in a few, there are some times where people are like, holy shit, look at this big thing moving. Maybe it's part of this. And there are times when, especially in combination with some story that people already sort of knew, people are like, oh, that's that guy, I know him, look at him, he's moving his Bitcoin, and you know, it sort of is part of a larger narrative. But outside of that, I bet there are people trying to do it. I haven't seen their attempts at this, so I don't know if it's successful. And if I had to guess, I would guess that it could be quite valuable if you combine it with the right meta knowledge to be able to pick out which things are really important, which things are just like, oh boy, like this exchange moved it from one wallet to another wallet. Bet that's irrelevant. But that it's not very effective if you aren't quite good at pruning it. But I'm kind of bullshitting there.
Okay. Moving on to Luuk.
Difficult to say as well. So I think what we're seeing in the volatility space is significant growth in all types of traders. So initially, I think we started out quite early in 2016. Back then, it was simply retail with a bullish view on Bitcoin and with an easy way to access, let's say, 6 months exposure by buying some calls. What we see nowadays is a big variety of traders, including a lot of miners from Asia, trading and hedging using Bitcoin options. We see investors hedging, we see people writing calls, etc. So the use case of Bitcoins has evolved massively over time, which includes people that use advanced solution for pricing, getting all kinds of statistics to properly price data and see what's actually happening. So different use cases for all different kind of traders, which wasn't available 1-2 years ago and which is available nowadays. So most likely the answer would be yes, but it would not be really visible.
Moving on to Mark.
Yeah, I think this is probably not a super popular trade. I mean, it could be, and you know, if it is, it's not something that people will probably talk very much about. But I don't think it's super popular. I think some people probably have like Satoshi's coins and some of the known wallet movements kind of tagged, and they have alerts on these things. But these are I mean, they've so far never moved, so it's not like they're super likely to move. But I think some people may have alerts on those things, or when a major government has coins that they've confiscated, it actually may be very relevant pricing information to you know, to see when those coins move. But ultimately, it wouldn't be specific to volatility derivatives. It would be delta one or volatility derivatives that you would use if you were to use that data and blockchain based data to take advantage of an upcoming price movement.
Certainly, thank you. Let's pick up one more question from the right-hand side. I think this question, you know, a lot of people are interested as well. It's the second question: which country is the most crypto-friendly for financial institutions? Starting from Sam, what are your thoughts on it?
Sorry, just had to restrain myself from giving an answer. Probably would not want recorded. So what's the actual answer here? It's fucking complicated, and it depends on what you're sort of maximizing for. And in particular, I think one thing I'd say is, like, you know, there are some countries where you can sort of do whatever you want, but you sort of get no respect for being there. You know, there are other countries where you can do almost nothing, but you get a huge built-in user base if you do it there. And you know, sort of on that second end of the spectrum, you see places like the United States, Korea, Japan, you know, the most highly regulated countries where, you know, there's a huge market there if you can access it. But, you know, the set of things that they have, you know, developed full regulations that are easy to roll out for is more limited. And so, you know, I think what I'd say is, like, you know, which is the most crypto friendly, and you know, I see the word country in there, but as you'll see, some of these things are maybe or maybe not countries. And this does change over time. Like, I think a year ago, a lot of people would have said China is like one of the most crypto friendly. But that certainly isn't something people would say now. And so, you know, Japan, people would have said 3 years ago, is one of the most crypto friendly. Then CoinCheck got hacked, and it turns out that a $600 million theft can do a lot to spur a country's regulatory body into action. And all of a sudden, you know, Japan is now a lot more restrictive than it once was. And so, where do you see people right now? I think you see Hong Kong. I think you see Singapore. I think you see still some in China, although obviously it's much more concentrated, much less so than before. You see regional places in Korea and Japan. And, you see some in Southeast Asia. There are some in Malaysia. And obviously some sort of scattered throughout the world. I guess Panama's about to get a new entrant soon into this game. And then obviously if you're asking where things incorporated, the answer is almost always going to be somewhere in the Caribbean for sort of ultimate place of incorporation. And so I think if you want to say like what's sort of the prototypical setup to copy, I'm guessing this is the setup that the majority of the people in this roundtable have. It's, some Caribbean country for ultimate incorporation, operating out of somewhere like Hong Kong or Singapore, and then sort of slowly working your way into other markets. But again, there are different answers to this depending on what you're targeting.
Fantastic. Thank you, Sam. Sorry for leaving for a little bit. I wanted to hear the story as well, but just internet. What are your thoughts?
Yeah, so for us, we just announced our decision to move. So I think in order to address the question, we can look at trading firms or exchanges. And to answer the question from an exchange perspective, we have seen new European legislation becoming effective this month in a few days' time, January 20th. Every country has its own interpretation. What we see in the Netherlands, where we are incorporated, is that the interpretation in the European version, which would force us to ask too much of our clients, KYC-wise, but also source of funding. So, for example, where does your money come from is sufficient. If you answer that by, let's say, savings for a majority of exchanges, we would be forced to ask salary slips, inheritance statements, that kind of stuff, which people from the other side of the world would typically not share simply because the Dutch regulations might ask that. So we were afraid of our competitive position. We were afraid of losing clients to more favorable regions or exchanges. And that's why we decided in the end to move to Panama. The move is effective as of February 10th, so we're preparing now. But at the same time, even though the rules won't apply to us, we are still implementing KYC measures. We're also looking at transaction monitoring, so we're still doing our part, but not according to European guidelines, but more self-imposed. In terms of trading firms, I think we see a variety of regions. Some of them are more tax-friendly than others, but we see activity from all across the world. But I think I would agree with Sam if I have to look at where, let's say, to launch, if you have the ability to choose whatever region you want. I think the Asian or Southeast Asia is more friendly versus the rest of the world nowadays.
Fantastic. What about yourself, Mark?
Yeah, from my perspective, at the end of the day, ultimately, I think the biggest companies in the world are very, very retail-friendly companies that are mostly unregulated or very lightly regulated. So if you think about Amazon, Facebook, Google, these companies basically either very slightly touch the regulated space or completely avoid it. And they end up choosing setups that are either tax friendly or regulatory friendly, and to the extent that they have to, they may partner with regulated organizations, but they'll try not to become regulated themselves, or again keep their regulatory burden fairly light. So I think the advantage that crypto startups have is that because they're dealing with a truly global market, and because they're operating on the internet and they don't have the need for physical presences like banks, they can optimize their regulatory setup. So I agree that a lot of the players are mostly offshore. We're based in Seychelles. We have a strong preference for Seychelles, but I think it's a similar setup in most situations. Hong Kong is extremely friendly in terms of places to live. Singapore is the same. We have lots of clients from Russia. We have lots of clients from all over the world. But it's one of those markets where you can be truly global, and so you want to pick the spot that kind of doesn't restrict growth and doesn't restrict the amount of product innovation you can have, because a lot of regulators may ask a lot of questions about products that by the time these questions are finished being answered, your competitors have already launched 10 products. It's like some of the players in the US are very handicapped by this. I think they still have been unable to launch Ethereum futures, for example, which I think pretty much every other derivatives exchange in the world has by now. So yeah, I think it's a similar strategy to a lot of the largest companies in the world.
Fantastic. Thank you, Mark. So we've also picked up some questions that we've found online. There are some questions that people are always asking when coming or talking about derivative exchanges. So here's one of the most common questions. How does your exchange handle queuing? Do you give priority to liquidity providers? Starting with Sam.
Alphabetical order. That's a joke. We don't care what your name is. No, it's just exactly the standard price time priority. There's no there's no last look. There's no like this person gets to jump ahead of the queue, or like fuck this guy's going to the end of line or anything like that. It's just strictly price is the first tiebreaker for all orders submitted before an active order would trade against them, and then for multiple orders at the same level, then it's just whichever was posted first.
Hearing from Luuk.
I think the answer is the same. So price time priority. So no last looks, etc. So it's simply the order that enters the book first, it gets executed first. So priority-wise, there's no favors. In terms of rates, we do make a distinction. So for options market makers, especially if BTC or whatever the underlying is moves, you need to update a lot of different series at the same time. So you need to be able to send higher number of requests, number of new orders versus, let's say, a perpetual trader. And for that reason, we allow bigger bandwidth, so more rates per second for options market makers.
Fantastic. What about yourself, Mark?
Yeah, so I think we're all using price time priority. There's no last look. The rumor is that some of the players that are kind of incumbent futures exchanges or derivatives exchanges are doing last look. I think it's horrible practice. We give everyone 200 orders per second, everyone the same queue priority, and everyone the same connection to our APIs and our systems. So it's very important that all professionals have basically the same playing field that they're working with from a fees perspective, connections perspective, any perspective really. Matt, you're muted, or I can't hear you. Actually, I think you're muted. Okay, Matt is gone.
So which questions shall we address next? No, he's reconnecting it, guys.
Yes, I am back.
Hey, Matt.
Sorry. Leaving the conversation is so rude. Okay, one more question from the internet side. This one's more on the compliance scene. What do you think are the biggest compliance challenges, including tax, KYC, AML, for example? What did you do to tackle it? Please give a little bit more specific answers. Hearing from Sam.
So, I think the first thing you have to do is you have to make some decisions about what, how your business is going to work. And, this is going to pretty radically shape how you approach this question. And, to sort of highlight that, you can look at BitMEX on one hand, and you can look at, Coinbase on the other hand. And, BitMEX decided that they're going to go down the route of no KYC at all ever. And so they have a whole host of challenges related to that. And, which are mostly around, like, are they allowed to operate in various jurisdictions? Like, is what they're doing limited by that? Like, I think it's probably a huge compliance burden, and do they have to change that? Whereas, Coinbase decided instead to, basically require full KYC from people. And so they have sort of the opposite set of challenges, which is like, is that a large hurdle for people, to sign up for the platform? And I think, you can see similar things with the jurisdictions they're in and everything else. And so, I guess what I can say is, what did we decide? I think that we tried to sort of, be fairly typical in what we did here, to sort of do our due diligence. We have, a fairly typical risk-based, KYC model where, the higher withdrawal limits you want, the more you have to KYC. And, we use Chainalysis and other tools to track funds. So, but this is all sort of tailored to like what you're going for here and where you see your business fitting into sort of global regulatory structures. But I would definitely say that of sort of the various things here, the biggest things that you're going to run into are things around AML KYC. So both the KYC side and how do you monitor clients' funds, if at all. And then separately, which is sort of a somewhat tangential thing, but if you're looking for banking, getting banking in crypto is not easy, and is sort of intimately related to the other decisions that you make on sort of regulatory matters. And it's very important, obviously, to the success of some exchanges.
Thank you, Sam. Moving on to Luuk.
Yeah, so for us, we spent the last months looking at the rules for Europe and specifically the Netherlands and how they would be, how they should be interpreted. We used a variety of lawyers, etc., and spent quite some money on the actual proper interpretation, which we still don't have. So it's not yet clear from a European perspective or Dutch perspective how to exactly interpret the rules. Are futures settled in BTC, etc.? Are they financial instruments? Yes or no? But we decided to move to Panama anyway to get rid of the uncertainty and give clarity to our clients, but also to make sure that we remain competitive, but still have the ability to choose our approach instead of being forced to have, let's say, the Coinbase approach. I think we've made a wise choice. I think the feedback is positive. People understand. But as mentioned before, we are going to self-impose KYC requirements. So we have two levels, also based on withdrawal limitations. So the biggest challenge for us is simply launching this technically, which we'll do soon. So that's fine. You also mentioned how do you do it in terms of banned countries, etc. We have that comparable to other exchanges as well. So we can't offer our service to US clients or restricted countries. And technically, for example, if you are a German client and you travel to the US, it should not mean that you can't access your portfolio. So technically, you should have the ability to allow the Germans to access from the US using a US IP address when they're on holiday, for example, but not when this German resides in the US permanently. So technically, these are the challenges, but overall, it's a very simple approach. Transaction monitoring, Chainalysis, Jumio for KYC, we've engaged them for the standard services as they are the number one in the market, essentially used by a variety of exchanges. So that's what we're going to impose, and we might change over time, but this is the way going forward, at least for the coming period.
Thank you very much, Luuk. What about yourself, Mark?
Yeah, so I mean, I've been operating crypto exchanges for 7 years, and this is the sort of thing where anytime you're handling fiat and kind of onboarding fiat into the crypto space, that's where you have the biggest room and biggest kind of open target on your back for money launderers. So this is kind of one of those things where moving into the derivative space, kind of a year and 2 years ago, allows you to get away from fiat because you can deal with stable coins instead, where ultimately most of the money laundering comes from within the banking system. Once you leave the banking system, it closes off the vast majority of opportunities for money laundering. But and CoinFLEX, we do KYC on anyone funding and Tether and stable coins. We do chain analysis and blockchain monitoring on all customer activities. I mean, it's a lot of the standard stuff that most exchanges are doing. And then additionally, ultimately, when it comes down to any regulator in any jurisdiction, what they care about is complaints. So it's not so much are you following the exact letter of the law? Because in many cases, there may not be specific laws related to crypto derivatives exchanges. So they may not be able to even answer that question. So if you're offshore, it may also be a question of how much does that law specifically apply to an offshore company. But what we do try to maintain a very careful eye on customer complaints and making sure we're providing a platform where everything is explained clearly. We're not trading on our own exchange. We're not allowing people to take out so much leverage and then they're on the hook for the funds. So everything is limited liability, and we have an ability where users are basically stopped out. And so these things are very important because ultimately you want customers to know what they're getting into and then have a good experience trading. And if they lose money, they know why, et cetera. Everything can be very laid out and very clear to a customer, and then that minimizes complaints and that minimizes the regulatory exposure.
Thank you very much. The next session is a more interesting one. I just thought about it. There's one kind of more key differences between you guys is on cash delivery and physical delivery. Of course, this part, it won't be go on. I want this to be more of an open discussion if possible. You guys feel free to jump in anytime, have a chat about it. I hope everyone can imagine you guys just having a small little conversation between a few of you guys and your thoughts on it in general. I know Mark has quite a few things to say about it in terms of what's the better approach or best approach. So keen to hear you guys have a mean discussion, probably just 5 minutes on it. And other thing. Maybe hear it from Mark first. I'll mute my microphone.
Yeah, sure. So I mean, everyone's terrified of derivatives, and I think a lot of the players that have kind of moved from spot into derivatives because they see more liquidity and cheaper fees and all the benefits that derivative entails, the ability to short, etc. All of these players that are moving in, they're kind of worried about, well, now that I'm trading derivatives versus spot, what does this mean? How do they work? And so one of the things that physical allows you to not have to deal with is manipulation, particularly at expiry. So with cash settlement, the reference price is a spot exchange, and it might be one spot exchange or several spot exchanges. The manipulation problem is basically present however you do it, whether you go the approach of taking lots of spot exchanges or a very, very small number. So for anyone who's holding a position or holding a lot of OI, especially if it's leveraged OI, they're kind of vulnerable. You're kind of vulnerable to this form of manipulation where you can move the spot price, and that can mess over a derivatives price because it's settled or priced or marked based off an index of these exchanges. That's one problem. But the second thing is in derivatives, they create huge basis or basically difference between spot and futures. And the basis creates this funding opportunity. So anyone with dollars that doesn't want to buy Bitcoin but wants to participate in the crypto markets can basically buy spot and sell futures. And if you do this in, Luke, thank you. So if you do this on a cash settled exchange, basically the basis trade on a cash settled exchange is limited to algorithmic trading firms because you have to buy spot, sell futures, and then at expiry, you need to do extra steps to close out and take the profit from that trade. Usually you're unwinding your futures position and doing an additional spot trade as well. With physical, and you also are vulnerable and exposed to this manipulation problem at a high degree, and you may need to do many, many trades. Whereas on a physical market, you literally just need to buy spot, sell futures, You can hold it to expiry and collect the profits. There's no extra steps, and it makes the funding trade much easier to do. So that's why a lot of people, especially large players and especially lenders, but anyone really trading with OI prefers physical to cash settled. And in traditional markets, physical is like 95% of the market.
So I have a little bit of a different take on it. I guess not surprising, given that we made a different decision on it. The first is that I think it doesn't make a ton of difference. Like, they are fungible with each other via hedging during expiration. And I think there are pros and cons to each. And I think, as Mark said, sort of the advantage of doing cash settled, physically settled, is you don't have to worry about the mark price, about any expiration price. The advantage of doing cash settled is, well, if you physically settle it, people need to actually have the deliverable. And so if you can imagine someone who, buys Bitcoin futures on 5x leverage, and then expiration comes about, they probably don't have 5x their total capital of dollars ready to deliver. Like, that's sort of the whole point of leverage. And so if you can't cash expire them, then they're just going to get liquidated or be forced to trade out going into expiration. And if they're forced to trade out, there's probably going to be a big premium or discount that they're running into. And if they get liquidated, they're almost certainly losing to that. So, I think there are pros and cons to each of them. And I think that, sort of what depends on here, what this depends on is how easy is deliver. Is this thing where everyone can deliver easily? The answer in crypto derivatives is no, not traditionally. And then the other thing that I'd say is, I think using an index definitely solves, an index with a lot of components solves a lot of the problems, although, as Mark said, not all of them. Another thing I'd say is I think it is a little bit split in the financial world. I think different sectors have different norms about what's physically versus cash settled. I think you see, stock index futures are almost always cash settled, whereas, a lot of commodity futures are going to be physically settled. And so I think it really depends here on which sector you're looking at. I don't think it's like super consistent, and I don't think that sort of there's an overwhelming vote from traditional finance of what the right thing to do is there.
I think I agree. So what we see in our futures market, we ask our users for feedback all the time, especially the bigger ones, volume-wise or open interest-wise. And I think they're fine with the setup now. So over time, this might be changing if the demographics of the traders change. But for now, we don't hear complaints about our setup whatsoever. What Mark said in terms of manipulability of the index might be true if you depend on one or two platforms to determine the index price. For us, we have 7, so that means around 15% contribution for each index. We exclude the outliers as well. It's very difficult nowadays with the size of the market to manipulate this many markets at the same time. So I don't think the manipulation argument is still valid. But traders or miners or whoever might have a preference for physical delivery over an index price. So cash versus physical remains an interesting topic, but I think for now it doesn't hold us back. I don't think any of our clients are impacted volume-wise or trading-wise by our choices. We might change over time, so there's no extreme conviction. It's simply a choice made, and we might be willing to change over time should there be a need to.
Hey, Mark, would you have anything that you would like to add?
Yeah, I'll just say the nice thing about Bitcoin is it's basically one of the easiest things in the world to deliver. Stock indexes, you can't really deliver a stock index, so there's no actual physical option available. And commodity futures like gold are deliverable, but it's really hard to deliver gold. I think the reason why most of us are in crypto is because we're passionate about the actual underlying cryptocurrencies themselves. I've been holding Bitcoin since 2012, and I'll continue holding it until 2032 or beyond that. You know, the nice thing about Bitcoin is you can deliver it with your phone. So I think why not take advantage of that?
Yeah, I definitely agree. Bitcoin is super deliverable. That's great, and that's definitely an advantage for physically settled. On the other hand, stocks are deliverable. People deliver stocks every day. Trillions of dollars trade of them and then are delivered. So, you know, I don't think that makes sense. But I think the really big thing here is margin, is that, you know, the rest of the financial world operates sort of by default on margin between clearing firms. And so delivering things, even if they're not fully funded, is like generally not that hard thing to do. Crypto does not operate that way by default. And so even though sourcing Bitcoins themselves aren't hard, people are trading on leverage here, and that makes deliverability super hard.
Yeah, one last statement then. We are a small firm. We have 25, 30 people. If you compare us to the large Chinese or US exchanges, you see that especially delivering the sort of physical settlement of all these different coins. I'm not talking about Bitcoin only, but if you have 100 coins or 1,000 coins, they need quite a sizable customer support team in order to handle all failed deliveries and all the transfers that have gone wrong. So even though, yes, Mark, you're right, Bitcoin is extremely simple to deliver, it will cause problems with failed settlements for whatever the reason might be. And an index price is even more simple. So I think from a simplicity perspective, from the easiest solution, I think the index approach is simpler than the actual physical delivery.
Yeah, I mean, it depends on who you are. You know, if you're someone who's doing a basis trade and you basically just want to earn money on your dollars with kind of passively, I think you'll prefer physical 9 times out of 10. If you are looking to use leverage all the way up to the moment of expiry, then physical will be harder for you. But most people roll their contracts. Most people who are doing trading on leverage actually don't hold their contracts to expiry. We certainly see that. You know, we have a number of players that you know deliver every month, and they're mostly doing the funding trade, and then most of the volume just rolls. So I think some people find delivery hard. That's fine. They don't have to deliver. And then any of the passive guys, you know, kind of are comforted by delivery. So it in many senses depends on your kind of time priority and your you know capacity as someone with capital. But also it's like no one has to go to expiry. So the nice thing about futures is you can just roll.
I will say is that I'm not sure that's what I'd take that as evidence of. Like the fact that users on CoinFLEX mostly roll might be evidence that they don't feel comfortable expiring. And in fact, on most other derivatives platforms, we do see a pretty significant fraction of people expiring futures. And I think in general, I actually don't know the numbers off the top of my head, but my guess is if you look at like OKEX futures, which is the largest delivering non-perpetual futures exchange. I'm guessing that if you looked at changes in open interest going into expiration for their quarterly futures or their weekly futures, I would guess you'd actually see less than half of open interest gets closed down going into expiration, implying that more than half are just cash expired. But I don't feel very strongly about that. I could be wrong.
Yeah, I think in the traditional cases, and there's a lot of studies on this. Like in traditional futures, 90% of OI rolls. So I also don't know what it is on OKX, but in traditional markets, it's usually 90%, and that's pretty similar to what you'd see on CoinFLEX. So that's kind of using futures as they're kind of meant to be used.
So I definitely agree in traditional worlds, you see a lot of people rolling, but I do think crypto is different there. And I think one of the big things here is that delivering is way harder in crypto because of the lack of deliverable margin facilities. And I think that's a pretty significant thing. I also just think you see like in general, a different set of people holding futures. In the traditional world, a lot of the people holding futures are things like index funds, which are mutual funds, which are almost always going to be buying roles. Whereas I think in crypto, you tend to see people putting on positions more, people putting on non-permanent positions, and I think that and retail traders, and I think those all lend themselves more to expiring, relative to the other people. But I don't like feel super strongly about this. I definitely want to claim that everyone expires their futures in crypto. That's not true. Some people definitely roll. But I think that for futures that are cash settled, I think you see a pretty significant fraction of people choosing to.
I mean, we certainly get retail traders every month that hold their positions to expiry, and the nice thing about that is, they don't have to deliver. We can just we basically just size down or auto deleverage their position in the hours leading up to expiry. So it isn't something where it's onerous for people who don't want to deliver. It's just something where for those who actually want to earn funding, it makes it immensely better for a passive investor, because there's no real way to do the funding trade as a non-algorithmic trader, as a passive investor.
I think we've covered the physical part sufficiently, or at least I hope so. So that's why I thought let's add some nice chart from Skew, where you actually see the impact of on open interest, especially the future side, growing in a month's time from 2.5 billion to 3.5 billion, approximately rounded, which is a clear indication of market sentiment nowadays. So yes, of course, Bitcoin and the price development is the big cause, but you see the impact here. So the market is really growing, and it's about 40-50% growth realized in the last 2 weeks. So that's on a side note.
All right,
yeah,
thank you. All right, please continue, Sam.
I was going to say, I think that's super interesting. I also think, though, that you can look at and there has been some volume growth as well, but I think a lot of what that's saying is that sentiment got more one-sided, and in particular, long. Almost all futures are trading at a premium right now. In general, seeing more buyers and sellers of futures. And so I think that sort of the increase in open interest also sort of means, especially, going into this most recent run-up, we were seeing more bulls than bears in the futures market, and that's one way to think of it, or maybe just more people who had a natural short they needed to hedge than a natural long. It could be either or some combination.
Yeah, I think that's really correct. Basically, there has been a massive increase in leverage longs, and this is driving up the implied interest rates from futures. I think we're probably going to see implied rates going even higher, especially if sentiment during and leading up to the halvening and after the halvening continues to be bullish. Then the implied interest rates, like right now, they've been anywhere from 10 to 20%, and they could easily kind of blow past that and go into the excess of 30-40% interest rates. So, I mean, I think that's kind of one of the cool opportunities from the futures. They offer the ability for buyers to get leverage and express bullish sentiments, but they also offer passive guys the opportunity to make a lot of money from those buyers, and it can even be a situation where both sides win. The passive guys earn interest on earn yield on dollars, and then the active guys may pick a direction and they may be right. So it's derivatives can be really beautiful in that sense.
Thank you very much, everyone. I think Luke disappeared. Either way, for this part, we would probably put a pause on the last discussion. That was very, very interesting. Thank you very much for everyone's input. I thought it was very interesting. So last bit, usually I do this first, but this time I choose to put it at the last part because I want everyone to at least get to hear our speakers first before our speakers can tell us more about themselves. Oh, Luke just messaged me. System just. Okay, so the last bit, I wanted to have everyone to just give a little bit of an introduction about yourself, also about your data exchange. Right now, everyone has been hearing you guys for a while. Maybe they'll remember it even better moving forward. So I would hear it from Sam first. Sam, please give us your elevator pitch or an introduction about yourself?
Yeah. So I guess, in terms of elevator pitch, like, I don't know, I really like FTX. I think it's a pretty cool platform. I think it's, innovated a lot and really kind of pushed the space forward. And I'd just be excited for people to test it out, give us feedback on it, tell us what you want to see in it, and sort of add it to the set of places you consider. And, in the end, you should use what you like best, but I think it's got a lot of cool things.
Yeah, so CoinFLEX is the first physically delivered futures exchange. We're the basically only exchange to have volume ratio oriented contests. We're taking that to the next level with gamification and allowing people to create their own competitions and do all kinds of things on that front. So I think we're currently a very socially oriented trading environment, and we're going to go down that route a lot further going forward. And I think if you are a manual trader and you want an exchange that provides you a lot of tools to do look at CoinFLEX.
Thank you, everyone. I'll call it the end of this conversation. Unfortunately, Luuk is not joining us back yet. But once again, thank you very much to both Sam, Mark, and Luuk, of course, for joining our webinar today. I'm sure our audiences have learned a lot and have heard a lot of interesting information. Once again, I would like to thank Remo one more time for providing this platform today. Though the internet, especially my network, I can keep moving out and then skipping our conversations. This Remo event will go on for another 30 minutes. Feel free to stay around and network and speak to different people about the topic or anything related to crypto. Thank you.